Welcome back. On the previous DVD, we looked at bullish chart setups, and we looked at how we could use certain option strategies to take advantage and profit off of those setups. It's always fun to make money off the upside in stocks. Of course, this time, we're going to take a look at the dark side. We're going to look at how to profit as stocks fall in price. I'm not sure why it is, but ever since I started in this business, I always seem to get a little bit more of a rush out of profiting as stocks fell, as opposed to when they go up in value. I know it seems a little bit warped, but everybody can make money as stocks go up. Not everybody makes money as stocks fall. In fact, most people don't even understand that they have the ability to make money as stocks fall. So what I'm going to share with you in this DVD is a number of chart patterns that have proven successful, to me at least, over the years, and how we can profit off of them. So let's start off with one of my favorites. Here you've got a simple chart pattern. It's a series of higher highs and higher lows. And you can see, higher high here, falls back a little bit, rallies a little more, falls back a little bit, and consistently makes a series of higher highs and higher lows. But notice how each higher high and each higher low has less and less distance between them. In other words, this move is shorter than this move. This move is shorter than this move. And the same thing is true in the market when the stock is correcting. This correction is rather large, this one is shorter, this one is shorter. Taken all together, if you want to play connect the dots again, here we've got the support line, here we've got the resistance line. And what we have here when they come together is a rising wedge. Now remember, in the last DVD, we talked about a falling wedge. We talked about a falling wedge can be a bullish pattern. Even though the chart of a falling wedge looks horrible, it leads to a bullish type of a trade. This is a rising wedge. Everybody I know would want to own a stock that looks like this. But at some point, you don't want to own this anymore because as soon as that wedge comes together, the stock has to make a break in one direction or the other. And just like with a falling wedge, 85, 90% of the time, rising wedge is going to break to the downside. So let me show you how to trade it. Right up here on the screen, you see a chart of McDonald's Corporation. You all know McDonald's, wonderful fast food restaurant, wonderful stock, wonderful McNuggets. But this was one of my favorite trades of 2010. The reason I liked it is I recommended shorting McDonald's or actually buying puts on McDonald's stock based on this chart pattern in the midst of a very large up move in the stock market. In late 2010, the market was on a roll. The market was going up seemingly every single day, and it was difficult to find any sort of setups that you could profit on the downside. That's something I like to do, so I kept looking for stocks that looked to me like they had patterns that could eventually break down. And McDonald's, like I said, here's a stock that's going up every day. It's going up consistently. It's got a nice rising channel going on, but I noticed a rising wedge pattern. And you can take a look at the stock and you can see what I'm talking about. Right around the top part in May, you can see where the stock peaked in May and follow that resistance line all the way through to where it's trading around 78 at the middle of December. And just draw another line, a support line, from where the stock bottomed in July and follow that all the way up, connecting the dots along the lows, also to where the stock peaked in December. And you can see a sort of a wedge pattern coming together. Now there's a couple of things I want to talk about with the wedge patterns. As I mentioned before, 85, 90% of the time you're going to see rising wedges break to the downside. But you have to time it correctly, because if you get into this pattern, make a trade on this pattern too early, you can be stuck in a trade and wind up losing money because the stock isn't ready to break out of the pattern just yet. So you want to get as close to the apex of the wedge as you possibly can, as close to the point of the triangle as you possibly can. Worst case is, you want to at least be able to put on a negative or a bearish position when the stock bumps into the resistance line of the triangle. And you can see that on the chart here. You can see right about the end of the chart, it's bumping into the resistance line. That's a low risk way or a low risk spot at which to be buying put options. And that's what we did. Again, take a look at the chart, and you see the horizontal line there drawn around $71 a share. Let me explain why I put that together. In a wedge pattern, most of the time when it does finally break or finally correct, the move is going to be fairly violent and fairly large. Not sure what the mathematics are behind it, or not sure why it happens this way, but it seems to be the minimum expectation you can count on when a trade breaks out of a wedge pattern is a 50% move of that entire pattern. Let me detail that. You see where the wedge begins, the stock's at $64 a share. That's the beginning of the support line of the wedge pattern. And you see where the wedge ends, or where the apex is up around $80 a share. So you have a 16-point wedge. If the stock breaks to the downside, odds are, mathematically, it's going to retrace about 50% of that 16-point move. So we're looking for an 8-point move down from the peak at 80. 8 points from 80 drops it down to 72. So we're looking at McDonald's, which is currently trading near 80, dropping as low as about $72 a share, so an 8-point move. The reason this is important is because you want to be able to purchase an option that allows you to profit if the stock drops to $72 a share. Better yet, you want to be able to purchase an option that allows you to create the maximum profit if the stock drops to $72 a share. And I'll show you exactly how we did that in just a second. The other thing I want you to take a look at is the bottom chart. You can see the MACD indicator. Remember, that's moving average convergence divergence. Again, I don't know what it means. I'm not even sure how they calculate it. All I know is it's a momentum indicator, and if it's rising along with the stock chart, the momentum of the chart pattern is strong. If the stock is rising, but the MACD indicator is falling, that's a negative sign. That's called negative divergence. It means the momentum behind that rising move is weakening. And it's usually a pretty good sign that the stock is about ready to make a turn. So you wait until you see the MACD indicator lagging behind and creating negative divergence, and you wait until you see the stock get a little bit closer to the apex of the wedge pattern that you've drawn, or at least up until the resistance line of the wedge pattern that you've drawn, and then you can take a look at which sort of puts to buy. And as I mentioned, in this case, I wanted to buy puts that allowed me to profit if the stock was to fall to $72 a share. Now, at the time of this trade, I had two puts to choose from. I wanted to do a short-term trade because when stocks break out of a wedge pattern, the move is usually fairly violent. So we don't have to go out 5, 6, 7 months because the move will happen in a matter of weeks. And when a wedge breaks to the downside, remember we talked about this, stock breaks out to the upside, stock moves pretty good. But when stocks fall, they tend to fall a lot faster than when they move when they're going up. So I knew this was going to be a quick move. So I didn't have to buy a whole lot of time. And in this particular example, we purchased the January 75 put options. Now there were a couple of choices we could make. There were January 80 puts, January 75 puts, January 70 puts. Well, I wasn't going to buy the January 70 puts. That didn't make any sense because just by working out the wedge pattern here and working out the support lines, stock was only going to fall to about 72, or at least that was the calculation. And that's a nice little number because you can see where we drew it in on the chart. There's a handful of little former resistance lines up around 72, and we were able to draw a horizontal line that showed support at that particular number. So 72 made a whole lot of sense. Figured it was a pretty good shot the stock was going to hit 72. So buying the 70 puts didn't make any sense. The 80 puts at the time, the McDonald's January 80 puts at the time, were trading for about $3.50 bucks. Let me explain how that would work. We've got the McDonald's January 80 puts trading at 3.5. If I think the stock is going to 72, the value of those puts, when the stock's at 72, we have the right to sell the stock at 80. The stock's now at 72. The value of those puts is going to be about 8, which means whatever we paid 3.5 for, we'll be able to sell them for 8. So we make a little better than 100% of the trade. That's a good trade. Nothing at all wrong with that, especially if it happens in the time frame we're thinking. This is mid-December. I'm thinking by mid-January, we've got a nice little profit. But if you do the math on the 75s, the January 75 puts, we're trading for just about $1. If the stock drops to 72, we have the right to sell it at 75. The 72 puts are going to be worth at least 3 because we can go into the market, buy the stock for 72, instantaneously exercise our right to sell it at 75, and we've got 3 points of value there. So the options that we bought for 1 are now worth 3. Well, that's a 200% gain. So what would you rather make, 100% or 200%? The choice is fairly obvious. So we went with the January 75 put options on McDonald's. And take a look at how it worked out. You can see on the following chart, didn't take too long before the stock did in fact break down from the rising wedge pattern. Got a little bit of support around $76 a share for a couple of days, and then it collapsed all the way back down to, oh, look at that, $72 a share, right about where we pegged it to be. We were able to sell the put options for $3 at the high, and we had a nice little profit on the trade. Now, one thing I want to point out with this, it's the same thing I pointed out when we were talking about call options. When you're trading options, it's important to take profits along the way. When you get a fast move in your direction, you get a nice profit on the trade, take a little off the table. That takes some of the pressure off the trade. You don't have to watch it and constantly pressure yourself as to whether or not you're going to give back some of the gains or whether or not the profit's going to turn into a loss. Cash out a little bit. You got a double on the position, sell at least half the trade. That way you can take your original capital off the table and not have to be emotionally tied to the position. You're almost guaranteed a profit if you're able to do that. And you can still hold some of it for a further move down. So we had a pretty good profit on the trade on the initial move down to about 76. The options pretty much had doubled in price at that point. We were able to sell half the position for a double and hold the rest until we hit our final objective at 72. It's a great example of a rising wedge pattern. And what I love about this particular trade is this happened in the midst of a very strong overall bull market move. The S&P 500 was going up every single day, it seemed, during that entire time frame. McDonald's didn't play along. We were able to spot that trade early because we noticed the rising wedge pattern, and we were able to use a put position to profit off of it. Let me show you another one. What we're showing up here, the chart you see, is a chart of Freeport-McMoRan Corporation. Symbol's FCX. It's one of the largest metals and mining companies in the world. If you're looking to trade copper, FCX is the stock to trade for that. And you can see from the chart, if you didn't have the lines in there, that's a beautiful looking chart. It's a wonderful rising wedge, or wonderful rising channel. Stock is consistently going higher, higher highs, higher lows. Everything looks good. But once you pull those lines in there, support and resistance lines, you can create a wedge. And you see the wedge starts first part of June. At the peak there, you can draw resistance lines all the way through to the peak right now around $60 a share. And the support line starts late August. You can draw the support line all the way up through, and you can see where it peaks at around 57.5. And you can see how the support and resistance comes together. It forms a tighter, tighter, tighter wedge. And we're nearing the apex of the wedge. So this was a good target for a stock. That could reverse trend very quickly. Again, if you don't look at the support and resistance lines, if you don't look at the wedge formation, this is a wonderful stock to own. But if you're looking at this, this is a wonderful stock to take a look at playing the other side, which is exactly what we did. Now, if you look at the length of the wedge, we've got the bottom of the wedge around $32, $33 a share. We've got the top of the wedge around 60. So that's about a 26-point wedge. Half of that, 13 points, we can expect if the stock breaks to the downside of that wedge, we're going to lose about 13 points. So do the math on it, we're somewhere around $48 a share. And again, when you break to the downside of a rising wedge pattern, the move tends to be very quick, very violent. So we don't need to buy a whole lot of time. So in this case, I decided it made sense to buy some March puts. Could have bought August, could have bought September, could have bought October. That's too much time. We would have had to pay too much for the options. We wouldn't get quite enough leverage, not quite enough bang for our buck. So we went with the March series. Now it was a matter of which of the options, which strike price is going to give us the biggest profit. At the time, we were looking at the March 60 puts. And the March 60 puts were priced around $5 a contract. So that's $500 to buy the right to sell 100 shares of Freeport-McMoRan at $60 a share. Alternatively, there were the March 55 puts. March 55 puts at that time were trading around $2.20 a contract. So that's $220 to buy the right to sell FCX 100 shares at $55 a share. All of it before option expiration day in March. So our target for the stock was $48 a share. So really at this point it's just a question of which of these options is going to provide us with the biggest profit, the biggest pop, if the stock hits our target of 48. We're looking at the March 60 puts, currently priced at 5. If the stock drops to 48, we have the right to sell it at 60, instantly turn around and buy it in the market for $48 a share. It's worth 12. So our $5 put option becomes a $12 put option. That's pretty good. It's a 140% return, $7 on a $5 contract. The March 55 put option, we paid $220 for it. If the stock drops to 48, the value of that option is pretty easy to figure out. We have the right to sell the stock at 55. We can immediately buy the stock in the market at 48. So the minimum value of that put option ought to be 7. Well, that's better than a 200% gain. So here again, the question is, what would you rather make? 150%, 140%, or 200%? Again, the answer is pretty simple. So let's see what happened. On the next chart, you see, going forward a couple of months, exactly what happened with Freeport-McMoRan. You see how it broke the downside of the rising wedge pattern, and you see how quick that move was initially. It was a really fast 5-point drop out of the gate. Bounced around a little bit, but it was definitely in a solid downtrend, and you can see a series of lower highs and lower lows, until it finally did in fact reach our target of $48 a share. In fact, a little bit below that. We were able to sell this put option at a double as well. Both of these examples, the McDonald's example and the Freeport-McMoRan example, occurred during a time where the S&P 500 was really on a roll. Stock prices in general were going much higher. Everybody was bullish on the market. Everybody was making a bunch of money to the upside. We took a look at a couple of positions that gave us a chance to make some money on the downside. Love the idea of a rising wedge pattern. Rising wedge patterns tend to work out 85, 90% of the time. You will get a move in that direction. The important things to remember, though, is make sure that in each of the times that you go to this, you're looking at something like the MACD, the moving average convergence divergence. If that indicator is showing negative divergence with the chart, in other words, the chart's moving up, the MACD is moving down, you have negative divergence. That's a real good indicator that that rising trend is about to reverse. The other thing you want to make sure you're looking at is you get closer and closer and closer to the apex or the point of that triangle. The closer you can get to that decision point, the better your odds are that you're going to be in time of a breakout. If you do it too early, decide to buy puts a little bit too early, take a look at those charts again. If you did it too early, you wind up being underwater on the position fairly soon. So you've got to be a little bit patient and wait for everything to set up the proper way. Now those are good patterns to use when stocks in general are in a rising pattern. Stocks in general in a bull market, if you want to short stocks at that point, you got to look for something like the rising wedge patterns. But when stocks finally do transition from a bull market to a bear market, there's an even more powerful chart pattern to use to take advantage of it. It's called a busted momentum trade, and it's probably my all-time favorite pattern. Let me explain a little bit about how it works. You can look at most stocks, a lot of high-flying stocks. Take a chart of Netflix, take a chart of Chipotle Mexican Grill, take a chart of Google, take a chart of stocks that fundamentally you look at and you think, how in the world is it trading so expensively? I mean, Netflix, my goodness, it's a 73 times earnings. From a fundamental perspective, basically what that tells you is you would have to buy the stock and hold it for 73 years before the company earned enough money to pay you back your original investment. That's a fundamentally expensive stock. It's a fundamentally expensive stock at half the price. But had you tried to short the stock at $100 a share, you're now looking at Netflix, which is trading over $200 a share. You're taking a bath on the position. It made no sense to do because the momentum behind the trade was too strong. That's the difference between using fundamentals and technicals. Fundamental analysis tells you Netflix is an expensive stock, an overpriced stock perhaps, at $100 a share. Fundamentally, how do you justify any stock trading more than 40 times earnings? Netflix is 73 times earnings. That's a ridiculous valuation, but it happens. Go back to the days of the internet craze. You had stocks, we weren't even talking earnings, we were talking things like page views, eyeballs. How many eyeballs the company received every day? My goodness, who values stocks on that basis? Certainly doesn't make any sense to trade that way. Certainly doesn't make any sense to buy a stock that's valued on such metrics. Shorting them, though, even though logically makes a whole lot of sense, it wasn't profitable. In fact, if you shorted stocks during the heyday of the internet craze, you might have been right logically, but you were horribly wrong because technically the stock had too much momentum behind it. So if you're looking at short selling overpriced stocks, stocks that you think are trading at too high of a valuation from a fundamental perspective, you have to wait until the momentum of that position breaks down. You have to wait until a Netflix loses its momentum. You have to wait until a Google loses its momentum. Apple loses its momentum. Chipotle Mexican Grill, you have to wait before that loses its momentum before you short that. But they're wonderful trades when they do. Let me show you how this works. The chart we have up here is a company called Digital River. Not even really all that sure what they do, except when I saw the chart, I knew I had to short this position. Turns out they do something in the internet. Doesn't matter because really, they could sell hamburgers, they could do something on the internet, they could be a bank stock. It doesn't matter. We're trading options, so we're trading options based on the pattern of the chart. It really doesn't matter what the underlying business of the company is. We're going off of the momentum and the sheer emotion behind the trade. If you take a look at this, you can see how the stock had this beautiful rise between September and December last year. Wonderful, rising channel, stock's making higher highs, higher lows almost constantly, and then it levels off. It goes into a high-level consolidation period. And notice how that high-level consolidation period lasts just about 6 weeks. Stock bumps back and forth. Now the underlying line you see on the chart that's threading through there, that's the 50-day moving average. Now moving averages just take the price of the stock on any given day, add it up over whatever length of time you're trying to create the average, and then divide it by that length of time. So for example, a 50-day moving average takes the price of the stock for the last 50 days, adds it all up, and divides it by 50, and gets the average price of the stock over that 50-day period. 50-day moving average is used by an awful lot of folks who pay attention to technical analysis to determine the momentum of the stock. If the stock is trading above the 50-day moving average, the momentum is strong. It's in a bull market. If the stock is trading below the 50-day moving average, the momentum is weak, and we're in a bear market. Now, the way you look to profit off of this is when a stock crosses above or below its 50-day moving average. Take another look at Digital River. And you see as we get up here into December, the stock's going through a high-level consolidation period. And you see where that first arrow indicates the stock drops sharply below its 50-day moving average. Now that happened as a result of something fundamentally occurring with the company. At that time, Digital River lost a major client. That hit the news wires and everybody sold that stock off. And you can see that dramatic drop, dramatic pull lower. Usually following that, if you remember this when we talked about chart patterns, usually following a sharp move down, you get a little bit of a bounce off the bottom. Remember, we called it a dead cat bounce. Certainly with Digital River, that's exactly what we had. We had the stock moving along, big drop on news, drop below its 50-day moving average, and now it's bouncing back a little bit. And again, looking at the chart, you can see how the stock came all the way back up, and at the point on the chart here, the very end of the chart, it's now come up and kissing its moving average from below. A little kiss of the moving average from below. That moving average, if the momentum on this stock is actually reversed and has gone from bullish to bearish, that moving average should now serve as a resistance line. The stock should not make it much above that line before dropping again. The other thing I liked about this chart pattern is, remember when we talked about pennants? We talked about a stock that's gone along, sharp drop, typically the result of some sort of fundamental news, little dead cat bounce off the bottom, one sharp drop, almost always followed by another. One piece of bad news, almost always followed by another piece of bad news. So we had a handful of things going on with this trade. We had the potential for busted momentum. We saw the stock drop below its 50-day moving average. We had a pennant pattern working itself out. Stock had dropped, come on back a little bit. And we've got the stock now coming back up to kiss its 50-day moving average from below. There's no better low-risk spot to enter a short trade than to have a busted momentum trade, rally on back up, and kiss the 50-day moving average from below. If the stock jumps much above the 50-day moving average, you're wrong on the trade, close the position, typically take a small loss. But if you're right, that's the exact spot where it ought to gain momentum to the downside once again. Take a look at the second chart. You can see it didn't take long for Digital River to break down. It kissed that 50-day moving average line from below, and it was only a matter of days before we had that second spike lower. Now take a look at that second spike lower. Notice how similar it is to the first spike. It's usually what happens. You get one big spike down on bad news, you get a little bit of a recovery, and you get a second big spike down, usually about the same size and usually news-driven. In this case, Digital River announced earnings. Earnings that were somewhat below expectation, the stock sold off hard. Now what we did here is we purchased the Digital River February 35 put options, paid about $2 for them. So essentially we paid $200 for the right to sell 100 shares of Digital River at 35, anytime between now and option expiration day in February. And we were able to sell those at 4.5 by the time we completed the trade after that second spike lower. This is an example of a busted momentum trade. It is perhaps my favorite trade of all when betting on the downside. When trying to trade put options and betting on momentum, shifting gears from a stock moving from bullish to bearish, there isn't a better trade setup out there. It's probably my favorite trade out there, and it's probably the one I've made most money on over the years. Now, it hasn't been real popular over the past 18 months or so because we haven't had too many of these setups. The market's been in a strong move, stocks have moved higher, and you haven't seen a whole lot of busted momentum. We're slowly starting to see that, and as that happens, this will become one of your favorite trades as well. Let me give you one more to go with. Another one of my favorite trades. It's a head and shoulders formation, and we talked about that chart pattern on the previous DVD. Head and shoulders formation is a bearish pattern. It signals the reversal of a trend from a bull market to a bear market. And if you time it right, you can really make some money off of the trade. So let me show you how to do this. Now remember, with a head and shoulders pattern, we have a situation where a stock has typically been in a bull trend for a while. The stock goes up, makes a high, comes back down, corrects a little bit, goes up to a higher high, fails to make a higher low, rallies again, fails to make a new high, and then starts to break down. We've got the shoulders and the head. Again, it's a bearish formation, and it signals typically the reversal from a bull market to a bear market. And it can be a very powerful pattern. When you measure out the head to the neckline, oftentimes if you're really going to shift from a bull market to a bear market, the distance there is about 20%. Doesn't always have to be in order to make a trade. You can have a smaller type of head and shoulders formation. But when you have a head and shoulders formation and you're trying to figure out what is the possible downside on something like this, you measure from the top of the head to the neckline, however that much it is. When this pattern breaks down, that's going to be the distance. That's about the approximate distance. So everything works out mathematically. Not sure how it happens, how people's emotions create charts that are so symmetrical. It just happens that way. Learned a long time ago, not going to bother asking why, I'm just going to accept the fact that it does and figure out how to profit off of it. Let me show you an example of one that's set up recently. Over here on this chart, this is a chart of the iShares Dow Jones Transportation Index Exchange Traded Fund. Basically, it's a stock that mimics the transportation index. And you can see, again, here again, we've got this beautiful rising channel from September all the way through up until about January of 2011. Stock's consistently making a higher high, consistently making higher lows. Everything looks really well. But you can see, annotated on the chart here, you can see where we've got the left shoulder developed, stock came back down, made a low, bounced, made a higher high, creating the head to the pattern, dropped back down again to the same low, rallied once again and created the right shoulder. And you can see here how that stock looks like it's about ready to break down. You have support at 90, and you have the head up around 95. So when this does break, we've got a 5-point window that we're looking to make some profits off of. So the stock, once again, trading around 91, 90-ish right now, and we're looking, as soon as it breaks below 90, we've got a potential 5-point move in the stock all the way down to 85. Now, let me give you some numbers here. If we're expecting the stock to get down to 85, we need to pick an option that's going to allow us to profit if the stock, in fact, falls to 85. In that sort of a situation, we're not looking at buying something like the 85 put options, because if the stock only falls to 85, well, there's no value to the 85 put options. We have the right to sell the stock at 85, and it's currently there. What makes more sense is perhaps buying the IYT June 90 put options, which are currently offered around 4. In other words, we're going to pay $4 a share. We're paying $400. We have the right to sell IYT at $90 a share anytime between now and option expiration day in June. Stock is currently around 91. We're banking on it breaking below the $90 neckline on the chart and plummeting all the way to $85 a share. But here's the problem with this trade. We're paying $4 for the right to sell IYT at 90 with the expectation that IYT is heading all the way down to 85. But at 85, what's the value of those puts? We have the right to sell the stock at 90. Stock's at 85. The value of those puts is 5. So we're paying $4 now for the right to sell the stock at 90, thinking they'll be worth 5 later on. As much as I love this chart pattern, this is a stupid trade. You're risking $4 on an option to make 1. That's a bad odds trade. And see, the thing is, with options, you're not always going to have a tradable setup. You're not always going to have the perfect chart pattern with the perfect option price. Sometimes you have to be willing to pass on a trade. Sometimes there just isn't a trade to make. And in this particular situation, if all you're looking at doing is buying put options on IYT, betting that it's going to drop to 85, nothing here makes any sense. So we can get rid of it and go on to something else, or we can do something a little bit more interesting, called a spread. In the next DVD series, we're going to talk about combination trading, which includes spreads, includes straddles, and includes what I like to call Rip Van Winkle trades. And we'll do that next time.